This is our Forex blog for March 18th, 2013, and what you're looking at is our currency indexes. What these are is we statistically compare every currency to every other one, and we actually create a chart that looks like any other chart where you can see double tops, double bottoms, flag patterns, pennant patterns. You can put trend lines on it, you can draw fib levels on it, and it's extremely predictive. Let's say right here when I draw the fib level right here, the dollar was trending down. Obviously it went sideways most of the day. It went down to its fib profit target level, which normally markets reverse at, and you can see it found support. If it shot through there, then normally the 1.618 level acts as support, but you don't want to get in until it either pauses there and starts to go back up. So somewhere on this bar right here, maybe at 12:30, you would be looking to buy the dollar against whatever one is either weak or is giving you a sell signal. You know, it might be going sideways or it might be going up, but it gives a similar type of reversal signal. Also, we have our FX trend intensity, where we measure and statistically compare the dollar to every other pair, and pretty much at plus 80 levels, those trends tend to continue. You want to, once you spot that level, you want to wait for either a flag pattern or a pullback, and you want to buy the pullback if you see a plus 80 on here. Underneath the real-time momentum, we have the daily, weekly, and monthly trend. So the highest odds trades are when a currency is going up, shows a lot of intensity, and the daily and weekly trend match that, and then even a higher probability, slightly higher, 5% higher, is when the monthly also is up. Now the euro today pretty much gapped down Sunday and went sideways in a very narrow range, as you can see. Anytime you see a currency go sideways for even 2 or 3 hours, when it breaks out of that sideways range, typically you're going to get a nice sized trend. You know, because when the market's in a sideways rectangle pattern, it pretty much means that there's no one buying or selling. And also some traders are in long position, some are in short. If the market breaks out and goes up, everyone who's short is losing money that got short down here. And so they're all having to go in and buy to exit their trade at a loss, and that pushes the market in the other direction. So let's scroll this back and just look at some of the high probability trades today. First, in the euro, because it went sideways for so long, when it broke above here, it was likely to go up. You can see statistically on 2 occasions there was a lot of statistical momentum at that time. It pulled back to the hourly moving average here and found support. Once it broke back above there, there's another high probability. As far as the dollar goes, the point of control right here, it's underneath that. It tends to act as resistance. So anytime a market goes up and stalls there and can't get above it, it's high probability. It sold off and then came up to the hourly here and here, both instances where it's a pretty high probability short. This one right here is a pretty high probability short because it even had less momentum than before. You see this area here and here. So when hourly moving averages in gray, the point of control, previous day's high, previous day's low get hit and can't be, price can't get through it, then it's a good trade. You can see this instance right here is not a good trade because price broke from below to above the hourly. That's actually a bullish sign, and you would actually probably want to be looking to buy the dollar versus whatever one's likely to go down right here just a short time ago. You can, with these indexes, see things such as false breakouts. So if you got into this sideways breakout right here, which I would have done, I would have bought this and either had a small loss, break even, or a few pip win, depending on what the other currency was. If this one breaks out and fails here, against some currencies that are weak, you might actually make money because one currency's falling. Even though this one's kind of going sideways for another half an hour, you can still make money on a lot of these instances. If you were taking this trade against one that was weak and it reversed and went up as this one was going down, more than likely you would have had a loss. So with the yen, came up to the previous day's high and failed. You know, if you went short right here, the hourly is usually a pretty decent profit target level. When it breaks underneath the hourly, if you weren't already in this trade, that's a pretty high probability trade. And again, when you spot slightly lower highs or pullbacks to hourly, that's a pretty decent trade right here going up to 2 o'clock. So basically, you want to look at the indexes to spot what the trend is and whether it's going up or down, or whether you get any kind of reversal pattern, which I'm going to go over every day, watch these blogs for a week or two, and you'll probably see most of them that I use. And this is the easiest way of trading that I've ever discovered, and it's my personal favorite. You can see the pound here. Obviously, it trended down. It went underneath its hourly. This is a good trade. Came up to the hourly and went through it, but you have resistance here and here above it. It failed to go higher, so once it broke down right here, that's a high probability trade. You wouldn't want to sell the pound versus, the yen, because the yen's in a downtrend. But you can see 11 o'clock, the euro is trending up. It's kind of going sideways. So when the pound is, going down right here at 11 o'clock, you can trade that against the euro. You would want to basically buy the euro pound. Here's 11 o'clock. This particular currency went from below to above its hourly moving average. It's kind of going sideways right here, found support, broke out, and you can see it went up about 20 pips there in the next hour. And that's how you use this, the currency indexes. So let's take a look at some of the other ones. The dollar right here, very high probability sell. It's been underneath its hourly moving average all day at both coming up to 4 and 8 o'clock, both high probability times. Euro broke out to the upside right before 4, and at 8 o'clock, you can see this one's kind of going sideways. I might not take a euro dollar buy at 8, but mainly because this thing's been going sideways. If it broke out above the little wedge pattern, it would be different. So one of the highest probability trades in the euro versus the dollar is coming up to 4. The euro is gaining strength. It was going sideways for about 8 to 10 hours, broke out, and the dollar's weak, came up to the hourly right here, and failed. So a no-brainer trade coming up to 4 o'clock is buying the euro dollar. So as you can see, this chart as well is going sideways. Here's pretty much the low down here. It's in a nice little narrow range pattern, and right before 4 it breaks out. And our upper containment bands are up here. The hourly moving average is up here, and you can see that's a nice about 50-55 pip move, just trending straight up. And from 4 to 5, if you are watching the currencies, the currency indexes, you can see also from 4 to 5, the euro is just exploding up, and the dollar's trending down, but it's not going down that much. It's kind of found a low here, and it's not going any lower. It also lost its statistical momentum. So a little bit after 5, you want to be looking to get out of this trade. Now here's the first pullback in the euro that you might want to buy, somewhere around 6.40. And looking at the dollar, it had a pullback in the other direction. So if you see one currency super strong, the other one's weak, and they're both pulling back at the same time, watch that chart like a hawk. 6.40 is an excellent time to be looking for buys in the euro dollar. Let's take a look at this, 6.40. You got a pullback right here, and you can see it's starting to go back up. Looking at the range chart, we have a beautiful pullback, and up down bars tend to be very predictive on range charts. This is a 5 pips per bar range chart. It has nothing to do with time. The more active and volatile the market is, the more bars. If the market's dead, you might have 1 bar every 10 minutes. And so you went long when it broke out of that area, and it came up to the upper containment band, and our signals actually gave a sell signal there because we're underneath the value area low for the previous week. It's a very high probability sell signal at the upper bands. But regardless, you're looking for that trade, and you made about 15 pips here. Those are some of the higher probability trades. Let's take a look at some of the other currencies and spot some high probability patterns. Here the Australian, it's trending up, found resistance at the previous day's high, breaks out and makes a higher high today than it did the previous day. What's a good one to be that looks to be going weak at 6.30 right here? Well, the Swiss had a breakout above the hourly, so that's actually bullish. You would be looking to buy this if it broke out of that little wedge pattern. But coming up to 7, it breaks down, and wedge pattern, low volatility patterns tend to precede trends very frequently. You'll spot these over and over again, like here's one right here. volatility, very narrow earlier, and it gets even smaller and smaller. Breakouts tend to give big trends. So at 640, buying the Australian versus the Swiss makes sense. So let's take a look at the Australian Swiss at 630 to 7. Remember, the Australian very likely to go up. And let's put the Australian Swiss on the 5 pips per bar chart too. This will take about 10 to 15 seconds to come in. So let's take a look at this. First, on the Australian Swiss, we actually have the weekly and the previous day's value area right here. That's where most traders have positions in the Australian Swiss for the previous day and the previous week. Typically, the previous day's point of control and the previous weeks are, not anywhere close. They're usually a minimum of 15 to 25 pips away, and oftentimes 50 or 150 pips away. But in this case, this is a major area of support because they're both there. Secondly, you have the hourly moving average. It's holding support there. Let's go back and see the exact time again of when this one got strong. It was right before 7. So here's 7 o'clock on the chart. You can see this kind of has a nice little wedge pattern right there. Explodes up. And typically when currencies get above our upper containment bands, you just want to keep trailing your stop underneath each bar's 5. This is a 5 pips per bar chart. Just trail your stop 5 pips underneath each bar's low. So you'll be getting out of this trade here at 84. I'm sorry, 98.45 or so. You'd be in this trade probably on the breakout of this little pattern right here. It will round up. Let's just say you got in at 9,800. You made 40, 45 pips on that trade. Very quick, very high probability. And another thing that you can do is use our perfect oscillator. Most of the time, when the plus 80 levels get hit, price is either going to go sideways or down. When the bottom area gets hit, price is going to go up. You can see that happen here and here. The high, that was the end of the move. Every once in a while, price will go through and continue going. But what that means is it's gone statistically way too far for that time of the day. And not only can you use that to know that you're going to follow this trade and get out as soon as it breaks the previous bar's low. Don't just get out when it hits the plus 80, because sometimes there's an extra 10 to 30 pips in it for you. But as soon as you get out, you might want to, because it's so far above our upper containment band, and it's also at an extreme level, you might want to flip and go short because it's more likely to fall 20 pips than continue up another 20 pips. So anytime the risk versus reward makes sense, in other words, you're likely to make 20 to 30 pips while risking 5 to 10 pips, you got to take the trade even though it might feel uncomfortable. I love riding trends up, getting out, and flipping at the same time. So let's say I bought 10 standard lots on the way up. I'd exit by selling 20 lots, and I'd be net short 10. And as it comes down and kind of goes sideways, I probably would get out. I'm very much quicker to get out of counter trend trades than trend trades, by the way, which should be obvious to anyone. Now again, look at how good the perfect oscillator is, especially when you use it to find trends. Obviously, this is in an uptrend, so we would prefer the perfect oscillator to be at the minus 80 level to buy. I mean, just ideally finds these areas. This is a quick 20 pips, another quick 20 pips. And so a lot of people don't trade after 11 or 12, but with this tool, you can actually pick up 10 to 30 pips in an hour, hour and a half during the more dead times of the day, especially when you combined the individual charts with our currencies. Notice also the New Zealand, kind of in a volatility area here where it's getting lower and lower volatility. Typically, I'll oftentimes, if the longer term trend supports this, buy it right here versus the breakout of the high. But the New Zealand at 12, very strong. Let's see this one at 12. Notice the trend was down, comes up to the point of control, the hourly moving average is there and there. The New Zealand Swiss, excellent one, at 12 o'clock to buy. Strong New Zealand, weak Swiss, 12 o'clock, we're looking to buy this. I mean, this is as simple way to trade as you'll ever find. Here's 12 o'clock. This was in a little narrow pattern here, and this is a pretty lackluster trade, but your stop would be underneath the low here. Once it goes up and kind of goes sideways, you might want to put your stop here right underneath that bar's low, or if you're using a range chart. I didn't change the range chart to the Australian Swiss, but I'll do so right now. So you'll see one of the reasons why I like range charts so much. Alright, here's the range chart, and one of the nice things about this, and it's actually doing all the signals right now. I don't typically use the signals on anything other than the euro dollar, euro yen, pound dollar, pound yen. But every once in a while, they can help you, especially when the counter trend circles show up. At 12 o'clock, if you had bought this breakout right here, your stop would be underneath the range bar swing low right here. And when it's going up, and it just goes up 1 or 2 bars and it goes up, down, I'm moving my stop underneath here. I would have lost just a few pips. A lot of times you get a false breakout, pulls back, finds support. Wicks are oftentimes end of reversal. You get long again right here, and you made about 15 pips. So maybe you lost 4 or 5 or 6 pips, made 15, and you're up, you know, a little bit on the 2 trades. Let's find one last trade here. The CAD, false breakout underneath the low. And it just made a slightly lower low, comes back up and breaks out right here. Very high probability reversal pattern. Some days I'm going to focus mostly on trends, and other days helping people spot when trends aren't going to work, so that they can flip and go the other direction and catch, you know, a big directional move, which oftentimes happens when trends fail to go lower. Anytime a currency goes underneath the previous day's low, that's a very weak sign. If it immediately bounces back up, that's the exact opposite. It's a very big sign of strength. You can see here the Australian broke out and went up. So coming up to 8, this is a very high probability buy. The Swiss is weak already from these 4. I'm not going to go back and look at the dollar or yen at that time. So we have a strong CAD, weak Swiss, which means you want to buy the CAD Swiss. Let's go back and look at what time that was. That was coming up a little bit before 8. And this is another opportunity where having a range chart is going to give you a little bit more clarity. This is a huge bar on the 5-minute chart, but with a range chart, since each bar is 5 pips per bar, you're going to be able to see patterns on there that you can't on a 5-minute bar. You know, notice how it's going sideways, breaks down, the trend's down, you get a nice little pullback right here. You might have went short, found resistance at the hourly, you go short again. It's not able to go lower, it didn't go below the previous low, and when it breaks out, you know, above this area and above the hourly right here, you get in. And notice it's above our upper containment band. That's typically when it's going to run out of steam. It's also above the perfect oscillator, above the extreme plus 80 level. So again, this is not only an excellent place to be trailing your stop underneath each bar's low. You're out of this trade right here, you flip to go short, and again, you're going to be very careful going short. Move your stop down above each bar's high, and you'll be out right here in this bar. So you made, let's say 90.10, 92.15 in, 92.60 out. Well, I'm just going to round the entry up to 20. You made 40 pips on the way up, and you made 20 or 25 pips on the way down. 60, 65 pips writing it up and down using, you know, the currency indexes to find this trade, using our containment bands and the perfect oscillator to know when to get out, flip and go the other way, and make half as many pips as you made on the way up, going the opposite direction. So that's it. Pretty simple stuff. The key is to have bigger wins than losses. Don't worry about your winning percentage. Remember, break-even trades don't count for your winning percentage. So if you have 3 trades, 1 works and 1 loses money and 1 breaks even, you're only 33% winning. However, only 1 of the 3 trades cost you money. So winning percentage is bullshit. Don't even worry about it. Just focus on trying to get 20 to 50 pip wins, and the rest will work itself out.